This week, Bitcoin touched $74,000. Right now, it is sitting at $67,000. That is a $7,000 collapse in less than 72 hours. And the one question every single Bitcoin holder in America is asking right now is this: is this the floor, or just the beginning of something much worse? By the end of this video, you will have a data-based answer. Not opinion, not speculation. Actual numbers, actual on-chain movements, and actual institutional behavior that is happening right now and that almost nobody in mainstream media is connecting together correctly. Everything in this video is connected. Every data point leads to the next one. If you leave early, the final picture will not make complete sense. So stay with this. Let us start with what actually happened this week, because the story is more complex than the price chart alone suggests. On Saturday, March 1st, the United States and Israel launched military strikes on Iran. Bitcoin was already under pressure. The moment news of those strikes broke, Bitcoin collapsed from approximately $68,000 down to $63,000 in a matter of hours. A $5,000 crash triggered by a single geopolitical event. Now here is the first thing you need to understand about that crash. Every time there is a global crisis, a war, a pandemic, a financial shock, people make a prediction about Bitcoin. They say Bitcoin is digital gold. They say it is a safe haven asset. They say when the world gets scary, money flows into Bitcoin the same way it flows into gold. This week, Bitcoin failed that test. Gold went up during the Iran strikes. Bitcoin went down. Bitcoin fell to $63,000 while gold held steady and oil spiked higher. That distinction matters. And I will come back to exactly why it matters later in this video. Because there is a critical reason this happened, and it connects directly to where Bitcoin goes next. But first, something remarkable happened after that $63,000 crash. Within days of hitting that low, Bitcoin staged one of the fastest recoveries it has seen in months. It went from $63,000 all the way back to $74,000. An $11,000 rally in less than a week. What drove it? Two things happened simultaneously. First, the Bitcoin ETFs exploded with inflows. On March 3rd alone, $458 million flowed into US spot Bitcoin ETFs in a single day. BlackRock's IBIT took in $263.2 million. Fidelity's FBTC added $94.8 million. Bitwise contributed another $36.4 million. Then on March 4th, it got even bigger. $462 million in a single day. BlackRock's IBIT alone absorbed $306.6 million. That one product, one fund, $306 million in a single trading session. Over 3 consecutive days, the spot Bitcoin ETFs collectively pulled in $1.1 billion. The institutional money did not run from the Iran crash. It bought it. But here is where the story gets complicated. And this is the part that most channels are not explaining properly. At the exact same moment that $1.1 billion was flowing into the ETFs and Bitcoin was rallying towards $74,000. Something else was happening on the blockchain. Short-term whales, the traders and funds who had accumulated Bitcoin below $70,000 in the weeks prior, sold 66% of their holdings at the $74,000 peak. Read that again. The traders who bought between $60,000 and $70,000 dumped 66% of those positions right at the moment Bitcoin hit $74,000. On-chain data from CoinDesk confirms it. Bitcoin's rally to $74,000 triggered heavy profit-taking from short-term holders. The market recorded $1.8 billion in realized profits from that single rally leg. So while institutional money via the ETFs was flowing in, short-term traders were flowing out. That is why the rally failed at $74,000. Two forces of equal and opposite intensity met at that level and the sellers won. Bitcoin came back to $67,000. And now we are here. But here is the question you should be asking right now. Who was actually right, the ETF buyers or the profit takers? The answer lies in what happened immediately after the price fell back. On March 6th, something shifted. The ETF inflow streak ended completely. Not just slowed down, ended. On that single day, $349 million left the Bitcoin ETFs. Fidelity's FBTC alone saw $159 million in outflows. BlackRock's IBIT recorded $88 million leaving the fund. And here is the detail that changes everything about how you read this. Not one of the 12 US spot Bitcoin ETFs recorded a single dollar of net inflow that day. 0. All 12 recorded outflows simultaneously. That has only happened a handful of times since the ETFs launched. Then on March 7th, the outflows continued. Bloomberg reported that over the past several weeks, the ETFs have recorded a cumulative $8.9 billion drawdown from peak inflows. So within the same week, $1.1 billion in, been $349 million out. Institutions buying aggressively, been institutions retreating just as fast. What does that actually tell us? It tells us the institutional money is not operating with conviction right now. It is reactive. It bought the Iran dip aggressively. It sold when the price failed at $74,000. And it is now sitting on the sidelines, watching. That is the true picture of the ETF flows this week. Not uniformly bullish, not uniformly bearish, reactive and uncertain. But now here is what the mainstream narrative is completely missing. While all of that ETF noise was happening, all the in and out, the rally to $74,000, the crash back to $67,000, the outflows, a completely separate group of Bitcoin holders was doing something entirely different. Long-term holders, the wallets that have been accumulating Bitcoin for years, wallets that did not sell at $126,000, wallets that did not sell during the February crash to $60,033. Those holders added 212,000 Bitcoin in February 2026 alone. 212,000 Bitcoin, at an average price somewhere in the $60,000 to $70,000 range. After months of selling, after months of distributing at the all-time high, the long-term whales reversed course in February and started accumulating again. And then on March 4th, the same day the ETFs recorded their biggest inflow of the week, 31,900 Bitcoin left exchanges in a single day. That was the largest single-day exchange outflow since June 2025. Bitcoin worth over $2 billion at that day's prices was pulled off trading platforms and moved into private cold storage. To understand why that is significant, you need to understand what exchange outflows actually represent. When Bitcoin sits on an exchange, it can be sold immediately. But when it leaves an exchange and goes into a private wallet or cold storage, it becomes a liquid. The owner has made a deliberate decision to make it harder to sell. They are not positioning for a quick exit. They are storing. The same week that short-term traders dumped 66% of their holdings at $74,000 and ETF investors were rapidly reversing direction, long-term holders were quietly pulling 32,000 Bitcoin off the market and locking it away. Two completely different groups, two completely different behaviors, at the exact same price, in the exact same week. This is the split market nobody is talking about. Now I need to stop here for a moment and be direct with you. Everything in this video is market analysis and education. It is not financial advice. I do not know your personal financial situation, your risk tolerance, or your investment timeline. Markets are unpredictable and can move against any analysis. Before making any financial decision, please consult a qualified financial professional. What I share here is data and observation. How you use that information is entirely your responsibility. Now let us continue, because the next layer of this story involves a name most Bitcoin holders know. While retail investors were panicking at $63,000 and short-term traders were dumping at $74,000, Strategy, the company formerly known as MicroStrategy and led by Michael Saylor, made a very specific move. During the Iran conflict volatility, Strategy purchased $204 million worth of Bitcoin, not before the crash, during it. They did not wait for clarity. They did not wait to see how the Iran situation would resolve. They deployed $204 million of capital into Bitcoin while the market was at its most fearful. Strategy now holds over 500,000 Bitcoin. Their average purchase price is significantly higher than where Bitcoin trades today, and they continue buying. Every single week, every single dip. Whether you agree with their strategy or not, the behavioral signal is clear. One of the most well-capitalized and publicly committed Bitcoin holders in the world views $63,000 to $67,000 as a buying opportunity, not an exit. Now connect that to what Arthur Hayes, the former CEO of BitMEX and one of the most closely watched macro crypto analysts in the world, said this week. Hayes made a statement that received significant attention. He said the Iran war, paradoxically, is ultimately bullish for Bitcoin. His reasoning: wars are expensive. The United States government will need to finance military operations. The Federal Reserve will eventually be pressured to print money to fund that spending. And historically, when central banks print money, when more dollars enter circulation, hard assets like Bitcoin tend to rise in value. Hayes attached a price target to this thesis, $500,000. That is not a short-term prediction. It is a macro thesis. But it is a thesis shared by some of the most sophisticated financial minds in the crypto space. And it directly contradicts the panic-driven narrative that the Iran war is simply bad for Bitcoin. A short-term reality: Bitcoin failed the safe haven test this week and fell during the initial shock. The long-term possibility, according to Hayes and others, The same geopolitical event that crashed Bitcoin short-term could be the catalyst for its largest rally ever if it forces monetary expansion. That tension, short-term pain versus long-term thesis, is exactly where Bitcoin sits right now. Let us now look at the derivatives market. Because what is happening in futures and options right now tells a very specific story that the price chart alone does not reveal. Open interest in Bitcoin futures currently sits at $16.16 billion. That number was $15 billion just 1 week ago. It is rising, and Bitcoin's derivatives open interest has separately hit a 30-day high of $24.7 billion across the broader market when options are included. Rising open interest means more contracts are being opened, more bets are being placed, more capital is entering the derivative space. But here is the critical question. Are those bets bullish or bearish? The funding rate answers that question. Right now, funding rates on Bitcoin perpetual futures are neutral to slightly negative. In practical terms, this means traders who are short, who are betting the price goes down, are currently paying a small fee to maintain their positions. When shorts are paying, it signals that the market has more downward bets than upward bets open right now. There is also something happening in the futures curve that deserves specific attention. The 7-day Bitcoin futures contracts are currently trading below the spot price. This condition is called backwardation. In normal market conditions, futures trade slightly above spot because of the cost of carrying a position forward in time. When futures trade below spot, it means the market expects lower prices in the near term. It is a bearish signal in the short-term derivative structure. So the derivatives market is telling you, professional traders, right now, are positioning for more downside in the near term. But here is the contradiction that makes this genuinely interesting. The options market, which represents longer-term directional bets where participants pay a premium and accept defined risk, is telling a completely different story. The current call-to-put ratio in Bitcoin options is approximately 3-to-1 in favor of calls. For every contract betting Bitcoin goes lower, 3 contracts are betting it goes higher. There is a specific call option position sitting at $90,000 expiring on March 27th with 5,715 Bitcoin in open interest behind it. Real capital, real conviction, a specific date, and a specific price. And beyond that, $120,000 call options for later this year carries significant open interest as well. So we have a split in the derivatives market that mirrors the split in the spot market. Short-term futures traders, bearish. Long-term options holders, significantly bullish. 2 completely different time frames. 2 completely different reads on the same asset. Now let us go to the on-chain data. This is where the picture becomes clearest. There are 2 metrics that matter most right now. The first is the MVRV ratio. Here is what it measures in the simplest possible terms. Think of every Bitcoin in existence as having a price tag, the price the current holder paid for it. The MVRV ratio compares the total current value of all Bitcoin to the total amount collectively paid for all of it. When that ratio is very high, most holders are sitting on large profits and are tempted to sell. When it falls toward 1 or below, most holders are near their break-even or in a loss, meaning the people who are going to panic sell have already done so. The MVRV ratio right now is 1.25. In every previous Bitcoin bear market, the ratio has eventually dropped into the range between 0.8 and 1.0 before a sustained recovery began. We are not there yet. But at 1.25, we are closer to that historical accumulation zone than at any point since the bear market began in late 2025. The trajectory is downward, which means if Bitcoin continues to decline modestly, we will enter that zone in the coming weeks or months. The second metric is SOPR. It measures whether the Bitcoin being sold right now is being sold at a profit or at a loss. The current reading is 0.98. It has slipped below 1.0, which means sellers are now, on average, selling at a loss. They are not profit-taking. They are capitulating, accepting less than they paid to exit a position because they cannot tolerate holding further. In the language of market cycles, capitulation is not a warning signal. It is a transition signal. It historically appears in the late stages of a sell-off, when the sellers who are going to sell have nearly exhausted themselves. What follows is not always an immediate recovery, but it marks the period when the balance between buyers and sellers begins to shift. SOPR at 0.98 is that signal, appearing right now, and then there is the hash rate. Bitcoin's network computing power is currently at approximately 1,068 exahashes per second. This represents a sharp V-shaped recovery from a significant drop in January 2026, when severe winter storms in North America knocked significant mining operations offline. The mining difficulty also recently recorded its largest single positive adjustment in years, jumping 15% as miners brought machines back online and expanded capacity. Miners are the people with the deepest operational knowledge of the Bitcoin network. They have invested in expensive hardware. They pay ongoing electricity costs. When they add capacity, when they bring more machines online at current prices, they are making a financial bet that those prices make continued mining profitable. Right now, they are expanding aggressively. That is a long-term fundamental vote of confidence in the asset from the people who understand it at the infrastructure level. Before I move to the scenarios and what this all means, I want to briefly address something I said earlier about Bitcoin failing the safe haven test. When the Iran strikes happened and Bitcoin fell while gold rose, many analysts declared that Bitcoin has permanently failed to establish itself as a safe haven asset. Some went further and said this proves Bitcoin is purely a speculative instrument with no monetary properties. That analysis is technically correct in the short term, but historically shallow. Here is the context that matters. Bitcoin is currently held predominantly by two categories of participants: speculative traders and institutional funds with short-term mandates. Both categories, when a geopolitical shock hits, have the same instinct: reduce risk, raise cash, exit volatile positions. This is not a statement about Bitcoin's fundamental value. It is a statement about the current composition of its holder base. Gold does not face this same selling pressure during crises because gold's holder base is dominated by central banks, long-term sovereign wealth funds, and generational wealth portfolios, entities that do not panic sell. But here is the critical point. Bitcoin's long-term holder base, the wallets that have held for years without selling, did not sell during the Iran crash. They did not sell when Bitcoin fell to $60,033 in February. They actually added 212,000 Bitcoin during that period. The safe haven behavior already exists in Bitcoin. It just exists in a specific cohort of holders, not in the asset broadly. As that long-term holder base grows as a percentage of total supply, which the exchange outflow data suggests it is doing right now, Bitcoin's behavior during crises will gradually shift. Arthur Hayes' argument about the Iran war being ultimately bullish for Bitcoin rests on this exact logic. Wars require money printing. Money printing devalues currency. Bitcoin, with its fixed supply of 21 million coins, becomes more valuable relative to a currency that is being diluted. The short-term safe haven test was failed. The long-term monetary thesis remains intact. There is one more piece of context I need to give you before we look at the scenarios. It involves the United States government directly. 1 year ago, in March 2025, President Trump signed an executive order establishing the Strategic Bitcoin Reserve. The announcement was significant. The U.S. government formally acknowledging Bitcoin as a strategic asset worth holding was treated by many as the final institutional legitimization of the asset. 1 year later, the reserve has not purchased a single Bitcoin beyond what was already held from law enforcement seizures. The executive order requires congressional legislation to authorize new purchases, and that legislation has stalled. Sources close to the situation describe the initiative as having spent a year largely inactive while other political priorities dominated. This matters for price because it means a portion of the investors who bought Bitcoin in the months following that announcement bought with a specific narrative in mind: U.S. government accumulation driving structural demand. That narrative has not materialized. And when narratives fail to materialize, the holders who bought based on them eventually sell. That selling is likely a component of the current bearish pressure. But there is an important counterpoint. The Genius Act, the stablecoin regulation bill, is currently moving through Congress. And a separate congressional proposal for a formal Bitcoin reserve structure with permanent legislative backing is being pushed by Representative Nick Bijich and others. If either of these moves forward in the coming months, the narrative can be rebuilt on a stronger foundation than a single executive order. Watch Congress, not just the price. Now the scenarios. I want to keep this precise. No vague possibilities. Specific price levels, specific triggers, specific timeframes based on what the data actually shows. Scenario 1. The $66,000 floor holds and a recovery begins. This is the most immediately actionable scenario, and it requires one specific thing. Bitcoin must hold above $66,000 on a closing basis. That level has been tested multiple times recently and has held. As long as it holds, the technical structure remains intact for a recovery attempt. If $66,000 holds, the next resistance levels are $70,000, then $74,000, which was this week's failed breakout level. A clean break above $74,000 with strong ETF inflows and declining exchange outflows would signal genuine recovery momentum. In this scenario, the options market's $90,000 target by March 27th becomes a realistic possibility rather than speculation. What would confirm this scenario is beginning. Three things: ETF flows turning net positive again for 3 or more consecutive days, exchange outflows sustaining above 10,000 Bitcoin per day, and the fear and greed index beginning to move above 20 from its current reading of 12. Scenario 2. A deeper drop before recovery. This scenario is built on the 4-year halving cycle, which has governed Bitcoin's price with remarkable historical consistency. Bitcoin halved in April 2024. It peaked in October 2025, 18 months post-halving, exactly on schedule with previous cycles. The bear phase that followed previous halvings lasted approximately 12 to 16 months before the next cycle began building. 12 to 16 months from October 2025 puts a potential cycle bottom between October 2026 and February 2027. If that timeline plays out, the current price is not the bottom. The analytical firm ZX Squared Capital publicly stated this week that Bitcoin could fall another 30%. 30% from $67,000 means approximately $47,000. That would also be consistent with the lower range of MVRV historical bottom zones, when that ratio eventually falls below 1.0. The specific trigger for this scenario would be a confirmed daily close below $66,000 with high volume. If that happens, the next major support is the 200-day moving average sitting near $58,000. Below that, there is limited technical support until the $47,000 to $50,000 range. One specific risk factor that ZX Squared identified deserves attention. Several corporate Bitcoin treasury companies, businesses that have borrowed money to buy Bitcoin, could face debt servicing pressure in a prolonged bear market. If any of them are forced to liquidate Bitcoin positions to service debt, the selling pressure from that alone could accelerate a move toward lower levels. This is a known and quantifiable tail risk in the current market structure. Scenario 3. A macro catalyst breaks the pattern entirely. This is the scenario that neither the 4-year cycle framework nor the short-term technical analysis can fully account for, because it depends on external events rather than internal market dynamics. There are 4 specific catalysts that could fundamentally change Bitcoin's trajectory in 2026 in either direction. 1. A Federal Reserve pivot. If U.S. economic data deteriorates to the point where the Fed signals rate cuts, risk assets, including Bitcoin, would likely benefit significantly from the resulting shift in capital flows. Rate cut expectations reduce the opportunity cost of holding non-yielding assets like Bitcoin. 2. The Strategic Bitcoin Reserve legislation advancing. If Congress passes legislation authorizing actual government Bitcoin purchases, the narrative of sovereign adoption, which failed to materialize from the executive order alone, gets rebuilt on legally binding ground. The demand signal from even a modest government purchase program would be unlike anything the market has seen. 3. A forced liquidation event. If a major corporate Bitcoin holder, any of the companies carrying leveraged Bitcoin positions, is forced into a large sale, the market could see a sharp downward spike that clears the remaining weak positions and establishes a genuine capitulation low. Paradoxically, this kind of forced selling event would likely be the fastest path to a market bottom and subsequent recovery. 4. An escalation or resolution of the Iran conflict. A significant escalation could drive more short-term selling from risk-off capital, but a resolution would likely trigger a sharp relief rally as geopolitical risk premium is removed from all risk assets simultaneously. Here is the final picture. We have a market in which 3 completely distinct groups of participants are behaving in 3 completely different ways simultaneously. Short-term traders and reactive ETF capital are uncertain, moving in and out based on week-to-week news flow. They sold at $74,000 when the rally failed. They pulled $349 million from ETFs in one day when the trend reversed. They represent the noise. Long-term holders accumulated 212,000 Bitcoin in February. They pulled 31,900 Bitcoin off exchanges in a single day in March, the largest outflow since June 2025. Strategy spent $204 million buying Bitcoin during maximum fear. These participants represent the signal. And then there is the derivatives market, where short-term futures traders are positioned for further downside, while long-term options holders have placed hundreds of millions of dollars of capital behind $90,000 and $120,000 price targets later this year. 3 groups, 3 time frames, 3 completely different reads on the same asset. The way you interpret this depends entirely on which time frame you are operating in. If your horizon is days or weeks, the data supports caution. Backwardation in futures, negative funding rates, ETF outflows, failed $74,000 breakout. If your horizon is months or quarters, the data presents a different picture. long-term holders accumulating, exchange supply declining, MVRV approaching historical bottom zones, SOPR signaling late-stage capitulation, miners expanding capacity, options market pricing significant upside. The divergence between short-term and long-term signals in this market right now is as wide as it has been at any point since the 2022 bear market. And if you studied what happened after the 2022 divergence resolved, you already know what direction it resolved in. Quick reminder before we close. This entire video is market education and analysis, not financial advice. None of the price scenarios discussed are predictions or guarantees. This market can and does move against every historical pattern and analytical framework. Always consult a professional before making financial decisions. Your capital is your responsibility. I want to leave you with one specific thing to watch in the coming week. One number, one level, $66,000. Every piece of analysis in this video converges on that level. It is where the 13,500 Bitcoin whale accumulation was triggered. It is where long-term holders have been building positions. It is the line that separates the floor holds scenario from the deeper drop scenario. If Bitcoin closes above $66,000 consistently through next week, the recovery thesis remains structurally intact regardless of short-term noise. If Bitcoin closes below $66,000 on high volume, the next chapter of this analysis begins. And that chapter has a different set of numbers in it. Watch that level, not the daily headlines, not the fear and greed score, not the ETF inflow figure on any single day, the $66,000 closing price. That one number will tell you more about where Bitcoin is heading in the next 60 to 90 days than anything else currently in the market. There is something developing behind the scenes that I have not yet fully addressed in this video. It involves the intersection of the strategic Bitcoin reserve legislation, the Genius stablecoin bill, and the Federal Reserve's next policy decision. Three events that are moving toward convergence on a timeline that most analysts have not mapped precisely. In the next video, I will trace exactly how those three things connect, what the timing looks like, and what it means for Bitcoin's price structure in Q2 2026. The people who understand that picture before it becomes mainstream news will be considerably better positioned than those who are reacting to headlines after the fact. One question before you go. Given everything in this video, the ETF flows, the whale behavior, the on-chain data, the macro picture, the Iran situation, where do you think Bitcoin will be trading on June 1st, 2026? Not what you hope. What does the evidence suggest to you right now? Drop the number in the comments. And one word alongside it. Bull, bear, or neutral, depending on how you are currently positioned. I read every comment in the first hour. And the collective read of this community, people who are actually in this market, with real money on the line, is consistently more grounded than most institutional forecasts. The next video goes deeper. Stay with it.